So what am I referring to? What I'm referring to is how you can take an investment asset and use it to wipe out your day job taxes. You know, you go to work every day, you make this W-2 income, you go to your preparer and you say, what can I do to lower my taxes? Typically what they'll tell you is cut your salary. That's one way to lower your taxes, or make charitable contributions. Well, neither one of those is oftentimes very appealing to someone when it comes to, hey, I need more money in my life, not less. So what are my options? Well, one option for you is to take something that everyone's doing and turn it into a tax deduction machine. So what am I referring to here? What I'm referring to is depreciation. Now, it's a very particular type of depreciation that we want to take advantage of, because standard depreciation, well, if you're a W-2 wage earner, it's not really going to help you. And what do I mean by standard depreciation? What I'm getting at is if you buy a piece of property, okay? So let's say I go out there and I purchase a rental house like this, and I buy this house for $500,000. Now, rental property is depreciated. Per the tax code, you have to depreciate the property over its useful life. And for real estate, the useful life of residential property, which is 4 units or less, is 27 and a half years. So this is how a lot of CPAs handle residential real estate for their clients. Now, hold on a minute before I go any further. If you're wondering, at this point in the video, you're saying, well, I don't have investment real estate. Well, I get it, but this is something you ought to consider taking advantage of by going out there and acquiring the rental real estate to take advantage of the strategy I'm going to be sharing with you. Okay, so what does that mean? Well, what you do is you take the asset itself, the structure, not the land. So we break it up and we say, all right, this particular house right here is worth $400,000. So what I'm getting at to reach this $400,000 is that you have a land cost that you can't depreciate. So assuming in this property here, my land cost is going to be $100K. So that's how I arrived at the $400,000 value for the structure. So with standard straight line depreciation, what we're doing with an asset like this property right here is we just have this little scale. And, 1, 2, 3, all the way up to 27.5 years. And we put the value of the property right up here at $400K. Here's your house. And then we just depreciate it over time. So we take 27 and a half and divide it by the $400,000, which equates to about $14,000 a year you're going to be able to write off as this house depreciates over time. That's straight line depreciation. Now, if you're a W-2 wage earner and you earn less than $150,000 a year, you can take advantage of this $14,000 and write it off against your W-2 income. So for example, right here, if I was a W-2 wage earner and I was generating $110,000 a year from my W-2 job, and I bought an investment piece of real estate, I could take $14,000 here in depreciation and offset it against my $110,000 in W-2 income. Now, this assumes that we don't have any other income from our property and taxes and all that stuff. I just want you to get the concept of how depreciation works. Now, for many people, we have two problems with this. Okay, the first problem is we don't have excess depreciation that we can use to offset our rental income until we have multiple properties. And that is because our property itself has generated income. Maybe this rental property here generates for me $25,000 a year in income. Well, I'm going to take that income and use this depreciation down here to deduct it against my income. So rather than showing $25,000 in income, I'm instead going to show $11,000. So that means I have no depreciation losses to use on this side, so there's really no benefit to me. Well, what has changed and what makes this such a benefit for us is that with the new tax law that was passed this year, the big beautiful bill, you probably heard about it, one of the things that they did is they went back in and they reenacted or reinstituted the bonus depreciation on accelerated depreciation. So if you're not familiar with accelerated depreciation, let me draw it out for you. So with accelerated depreciation, what you are doing is you're using that same scale again. Let's say we have this asset right here, this house, and it's over 27 and a half years, 1, 2, 3, 4, 5, etc. With accelerated depreciation, we look at this asset and we say, hey, rather than take 27 and a half years to write it all off, we'll accelerate it and allow you to write it all off. And say this example, you were allowed to do it in year one. So in year one, you could deduct the entire amount of that asset. Okay, so with accelerated, they're pushing the time frame up and saying take more of it sooner. Now, how does this concept apply to real estate? Because this isn't realistic here. That doesn't apply 1 year writing off your house. The way it applies for real estate investors, which is really important to understand this concept now, is that the components of the property, this house, is comprised of more than just the framing. All right, it's comprised of foundations, it's comprised of sinks and wiring and fixtures and carpet and roof and landscaping and driveways and grass and lawns and all these little things that make your house your house. Now, under the Internal Revenue Code, you're allowed to take certain components of your property that make the entire property, and you can write off certain amounts at an earlier. Rather than the 27 and a half years, what they do is they put in a couple of different numbers here. They have a year 5, and, well, let me redo this. They have a year 5, they have year 7, and they have year 15. And so they look at your property and they say the components of that property are really comprised, or a good portion of it, of 5-year, 7-year, and 15-year property, meaning that there are certain aspects of this house that in year 5 will no longer have any useful life, that have always been used up. So what would that be? Maybe it's your refrigerator, maybe it's your carpet, okay, maybe it's your sinks, things like that. And so by year 5, all that has been used up, so you can depreciate it within 5 years. Okay. Now we go to 7-year. Now 7-year property is typically business stuff, so it's not going to apply on the residential side. Then you get up here to year 15, and what's going to be there? Shrubs, other landscaping, driveway, things like that. Some of the harder assets are there. So what we're doing now with your property is we're hiring someone to come in, look at your property, and they do it's really simple. What they do is they have you go around with your phone on a FaceTime, and you go through and you show them your entire house, the outside of the property, all the components to your house, your water heater, your furnace, your AC unit, and they take all that and they stick it into a program, and it punches it all up and says, all right, of this house right here, all right, this property, we have approximately $65,000 in 5-year assets. That means within 5 years, you're going to have to replace all that. It's going to cost you $65,000 to do it. Now, by year 15, we have an additional $35,000 in things that are going to need to be replaced. So they determine what that is. And so in my example right here with this property, generally speaking, if you have a property that you bought it for $500K, we take off the land value of $100,000, which leaves us with an asset value of $400,000. Roughly 25% of that house will be categorized as either 5 or 15-year property. So that means it's eligible for this accelerated depreciation. So you don't have to wait 27 and a half years to use up the entire amount. They'll allow you, the IRS, okay, so we take this at 25%, that equals $100,000. You're going to be able to take that $100,000 a lot sooner. It's a phenomenal strategy. It'll put a lot of money back in your pocket if you're taking advantage of it. And if you want to learn more, go into the show notes. I have a link for a free strategy session where you can speak with one of our strategists here at Anderson, and we can walk you through this strategy and show you how you can put it into effect for yourself this year and make sure you're maximizing your tax deductions before it's too late. If you liked the video, be sure to hit the like button, and I wish you the very best with your investing.